Hello, everyone. We're glad you've been able to join the event so far today. We're now going to explore the topic of self-funded retirement, what to consider. My name is Andrew Hambling. I'm an education manager at Australian Super. And also in the background today, the education team are available via the Q&A button to answer any questions you have, and they will answer as many questions as they are able to. We also have a number of different resources for you to view across today's event. It's important to remember that this content may contain general advice, and we haven't taken into account your own personal needs, objectives, or personal circumstances. I'm also joined today by Mark Vincent, who is a financial planner, and he has a license through IFS or Industry Fund Services to facilitate the provision of personal advice to members. Hello, Mark. Welcome.
Hello, Andrew. Thank you for having me along today.
Thank you. For many people who are self-funded in retirement, thinking about how long their money will last is very normal and it's very human. Australia generally has four building blocks of retirement income. Your income in retirement can come from a mix of these different sources. For some people in retirement, income from the government age pension may not be available. When you're not expecting to rely on the government age pension, your super and your savings naturally take the centre stage. They're there to support your lifestyle, so it's understandable that people want to be thoughtful about how they use them. Decisions can feel more deliberate, and it's common to pause and reflect before spending or making changes, especially when markets move around. This is something we hear very often from members. In retirement sessions, many people tell us they want reassurance that their money will last and they're making sensible choices. This is sometimes called longevity risk. Simply the idea of making sure that your savings support you for as long as you need them. For self-funded retirees, these thoughts often show up in everyday practical moments. Can we comfortably afford that trip this year? How long should I think about spending when markets are or have been a little bit bumpy? What's a sensible balance between enjoying today and planning for the future? What's important and reassuring is often the questions we hear from people who, on paper, are often in a strong position. It's not a sign that something's wrong, it's a sign that people care about making informed, confident decisions. A big part of today's session is about helping turn that uncertainty into clarity so you can enjoy retirement with confidence, knowing that you've thought things through and have a plan that feels right for you. When we talk about longevity risk, there are really two parts to it. Making sure your savings support you long term and feeling comfortable enough to actually use your savings to enjoy retirement along the way. How do you see this longevity risk and considerations playing out, Mark, when you talk to members?
It's interesting, Andrew. I had a member the other day have the funny analogy that they didn't want to be the richest person in the cemetery because obviously they were fearful of spending too much and overspending, as we know, and running out of money before they run out. So it's all about balancing what they spend and how long it's going to last. And it's hard because we've been programmed to save all our lives. Saving to top up superannuation, saving for school fees. It's always saving, saving. And then in retirement, that actually goes the other way, and we should and could be spending our money. So getting that happy medium right, Andrew, can be hard sometimes, but with some planning and some modelling, we can give members that confidence that they are able to spend and they are able to travel and they are able to do the things that's important to them in retirement.
Thank you, Mark. Now, we have had some market up and downs over the last 6 months, and when markets are volatile, what do self-funded retirees usually worry about, especially when they see their balances move around?
So obviously, steps 4 and 5 are the most stressful times for most people, but especially self-funded retirees. While we're working, our employers are generally contributing into our super. We might also be contributing into our super, and we have income from wages to cover our day-to-day expenses. So we're not reliant on our superannuation to provide that income. So while markets can be bumpy, it's less noticeable, Andrew. However, when we're in retirement phase, no longer generating income from personal exertion, but drawing down on our superannuation to cover our living costs, these market downturns can seem a lot worse, a lot deeper, and a lot more uncertain for our members, Andrew. But what they have to keep in mind, it is a cycle. We've seen things like this in the past, and we will get through the trough. And if we can navigate that and hold our nerve, the upswing is generally the strongest point of the market where returns can be quite quick and quite plentiful. And then we go up and through the cycle again. So holding our nerve, Andrew, is generally the best plan of attack through these market cycles.
Thank you, Mark. Now, uh, generally, there's two parts to that. There's the part understanding the market cycles, but also how members feel. Do you want to talk about how you navigate this with members, about their level of comfort?
Yeah, you could almost call it the head and the heart, Andrew. The head knows that certain things will play out. The head knows that markets will recover based on history. The heart doesn't like seeing markets go down. The heart worries about how this is going to play out. So, emotional comfort can sometimes take over, but it's all about getting that happy medium between higher risk investments with higher potential return, but higher potential losses, and lower risk investments, Andrew, that might be more stable, but you have to expect a more moderate return over the long term. And this is very individual. This is very personal. People have had existing experiences, good or bad, with investments, and that can shape and frame how they feel. Essentially, can you sleep at night when the market is volatile? Yes, you're probably in a reasonable investment mix. If it's causing you angst and stress, it might be time to review this, Andrew.
Thank you, Mark. Now, one question we often get from members is what happens if I retire and sort of on the day I retire or in the first couple of years of my retirement, if we have market falls during that time, does that mean that personally my money is more likely to run out? Can you explain what members are considering there?
Yeah, listen, Andrew, that timing is obviously far from ideal. When we retire, we'd love to see some stellar returns up in the 8, 9, 10%, which would be wonderful, but the market can be cruel and timing can be unkind. We have to remember that even in retirement, we still have a long-term investment time frame. Ideally, somewhere between 20 and 30 years could be the average lifespan of a member's superannuation, depending at what age they retire. So while not ideal at the front end of retirement, we have to take the history as the guide for the future, and we will see corrections in markets and things may pick up. Now, to mitigate this in the short term, members may have a bit more money at the bank, especially if they've got short-term expenses. We're going on a holiday next year. We want to buy a car in 2 years' time. Having a bit more money at the bank to make sure that these short-term goals are funded rather than having to take extra money out of their super while it's already doing it a bit tough with downturns in markets can be a sensible strategy. Again, having the right investment mix that does have some more conservative investment assets like cash, fixed interest, and government bonds as part of your portfolio, that can help mitigate this risk to a degree as well, Andrew.
Thank you, Mark. Now, I'd like to look at some common super terms and some important rules that self-funded retirees do need to be across, especially when it comes to superannuation accounts. Now, there's a couple of different terms here. We've got transfer balance cap, total super balance cap, minimum income payments, and something called the Division 296 tax, which is coming in from the 1st of July. So, Mark, can you take us through these different terms and explain what they mean for members?
Of course, yeah. So these are all terms that the Australian Tax Office has brought into place to explain rules, limits, and legislation, Andrew. And some will apply to some people, others they won't have any worry about this. Some will be caught under many of these different rules or limits, and they need to be aware of which ones relate to them. And how they can potentially impact them now and moving forward into the future, Andrew. So, one is the transfer balance cap. So we know that once we're retired and over 60 years of age, if eligible, can move money from an accumulating super account into a retirement income account. Now, there are tax benefits with these accounts. So the government does limit how much members can have in this tax-free account. It's going up to $2.1 million on the 1st of July next year, Andrew. So that's the maximum amount of money an individual can hold in a superannuation retirement income account. Total superannuation balance, that looks at all of the members' superannuation accounts, whether there's one that's still accumulating, whether there's one that's in retirement phase, if members have a lifetime defined benefit government super plan as well, they are all captured in that. Now, where this comes into play is it can affect eligibility to make voluntary contributions, Andrew. So the number is the same, $2.1 million. So the government is saying once members get up and around near that amount, they do limit the ability to make contributions. So some may be eligible and some may no longer be eligible once you've hit this number, Andrew.
Thank you, Mark. And both of those terms do sound rather similar. So members can get confused why there is more than one term. So thank you for walking us through that, Mark. Another thing that members commonly ask us about, especially at retirement seminars, is around these minimum income payment amounts that can come from retirement income streams. Can you explain those, Mark?
Of course. So, when money is in an accumulation account, even if you're retired, there is no obligation to take a payment. You can let the money sit there for as long as you like. Moving it into a retirement income account and getting all those additional taxation benefits, it does come with a condition, Andrew, and that condition is each financial year, based on your age and based on your balance, you're required to draw a minimum payment. So let's say a member was aged 70. Their minimum drawdown is 5%. If on the 1st of July they had $1 million in this retirement income account, they would be required to draw down $50,000 for the financial year. Whether that's a fortnightly payment, a monthly payment, take it as a once-off annual payment, they have to take that minimum. It does slowly increase as members age because the government wants you to spend your money in retirement. They don't want you to be fearful of spending and squirrel this money away for a rainy day that might never come, or to pass down to future generations. So you do need to take this money out. But Andrew, you don't have to spend it. Just because it's paid out to you and now in your bank account, you're entitled to save that. Ideally, the government wants you to spend it. If you're under 75 years of age, and depending on your individual situation and circumstances, you may be able to contribute it back into an accumulation super fund. So it really depends on the individual and the circumstances. But ideally, this is income to fund retirement, Andrew.
Thank you, Mark. Thank you for explaining that. Now, it is important for everyone joining us today to be aware that the numbers do change and it's no different this upcoming financial year or upcoming new financial year, which starts on the 1st of July 2026. We can see that the contribution limits or the contribution caps are increasing. So for concessional contributions, it's going to be 32,500. Non-concessional caps increasing to 130,000. As Mark told us, those balance-based rules are increasing. So the transfer balance cap, and I believe, Mark, for the transfer balance cap, it's only for people who haven't already opened one of those accounts for the full cap there of 2.1 million. Is that correct?
Yeah, this is correct, Andrew. And this is where it does get very complicated and very convoluted. You get the ability to use your transfer balance cap, and it was $1.6 million quite a few years ago, but has slowly indexed up. So, depending on how much of your transfer balance cap you may have already used, the $2.1 million may be out of reach for some people. So, caveat that is for a new pension commenced from 1st of July 2026, Andrew.
Thank you. Thank you. We can see that the total super balance is also increasing to 2.1 million. As Mark mentioned, that does affect how much people may be able to contribute to their superannuation accounts the closer they get to that number. For non-concessional contributions, if they're looking at the bring forward rule, or potentially any catch-up concessional contributions if they were eligible. Now, what's new coming from the 1st of July 2026 is the Division 296 tax. Now, this is an additional tax to be applied on the realised investment earnings where a member's total superannuation value exceeds the $3 million threshold. Now, you'll see that there are some further requirements around this new tax and how it will be applied. And it is important to note, Mark, if individuals are wondering about their personal tax situation when it comes to super and these concessional caps and limits, where do they go to find out this information? Where's the first place they should be looking to find out where their limits are?
So, thankfully, all of the superannuation funds report contributions, balances through to the Australian Tax Office each year, Andrew. So, that data and information flows through to the ATO portal, which members can access through MyGov. So, MyGov, link in ATO, and then all this information is fairly easily obtainable, Andrew, through little click drop options. You can see concessional contributions, non-concessional contributions, total superannuation balance, all of the information that we've talked about here today. Pretty much, MyGov, ATO, it's a one-stop shop and reasonably user-friendly too.
Thank you. Now, I'm sure a number of members that have joined us today are wondering around this Division 296 tax, if it is going to be relevant for them, how that's going to impact them. So we do actually have a case study today around how it works. So we're going to look at a member today named Jill. Mark, would you like to take us through how the tax would play out for Jill on an example today?
Of course, Andrew. So there was a lot of speculation in the media about this proposed tax, and it went back and forth for quite a while. And there was a lot of fear that it was going to cause a lot of issues for a lot of people. So they've revised it, and it's possibly not going to be quite as bad as a lot of people first thought, thankfully. So all they care about in Division 296 is balance in excess of the $3 million or in excess of the $10 million. But we'll just focus on the $3 million today, Andrew. So Jill had her super fund report that at 30th of June, she had a total super balance of $3.1 million. So the threshold is $3 million. She's exceeded that by $100,000. $100,000 is 3.2% of her total super balance. So 3.2% of her super is under the microscope for additional earnings tax. Now, they only care about the realised capital gains or realised investment earnings. So that's a big change, and that's going to help a lot of people. So Jill earned $250,000 for this account for the year, which would have been about 8%. The assumption is. Of that, about half of it was realised earnings, so about $125,000. So the $125,000 is the portion that was realised. Only 3.2% of that the government cares about because that relates to the amount she's exceeding her threshold. So there's $4,000 of earnings that are attributable to the amount that she has over her $3 million. 15% tax is the normal tax up to her $3 million, and then another 15% is levied over and above. So 15% of Division 296 tax, an extra $600 on her $100,000 over and above, Andrew. So not too bad in the scheme of things.
Thank you, Mark. And it's really important for the members that have joined us today, where this might be applicable to them, to really understand how this will now work under the rules that have been legislated, as opposed to some of the things, as you mentioned, that were initially discussed, which might have been quite different from where the legislation did end up. So thank you for taking us through that. Now, another thing Mark, that people need to consider if they are self-funded and they might potentially not be eligible to receive the government age pension or the associated pension card is there are some concessions that they might be
Mm.
eligible for, such as the Commonwealth Seniors Healthcare Card. So how do you look at this for members when you're talking about concessions and healthcare cards?
Yeah, a lot of people are quite surprised that they may be eligible, Andrew. The key to the Commonwealth Seniors Healthcare Card is eligibility starts at 67, which is age pension eligibility. It's not asset tested, which is a huge benefit for a lot of members. The other benefit is it doesn't look at actual income. It looks at assessable income, adjusted taxable income. So, what that means for income accounts that have been started semi-recently, if members do have one that is quite old, pre-2015, they may be treated differently. But let's assume these are all new income accounts being started recently, Andrew. For a single person, it's over $100,000 of adjusted taxable income that would then prohibit you from receiving the Commonwealth Seniors Healthcare Card. So Centrelink Services Australia use something called the deeming method to work out what kind of income your income account from super is paying you, not the actual income. There's a couple of rates they use, but very, very loosely, if a single person had, let's say, $2 million in an income account, retirement income account, the asset is not tested, Andrew, but the income is deemed. They would be deemed to earn a bit over 60 something thousand dollars of assessable income. They could be drawing actual income of $150,000, which is over the 101,105 cutoff limit, but because it's deemed, they're actually eligible, Andrew. So a lot of people may think, oh, we're drawing more than that, we're not eligible, which is not actually the case. So important that they, get some education and advice on this potentially.
Thank you, Mark. So, yeah, that really is the takeaway. Many people rule themselves out. Don't necessarily rule yourself out for these concessions, such as the Commonwealth Seniors Healthcare Card, until you've actually tested whether or not you are potentially eligible or not. Now, one topic we haven't covered as part of our self-funded retirees topic today is who inherits my super. So, we do have a couple of estate planning presentations as part of today's event. It is a really important consideration, and that's why we have separated them as separate topics as part of today's event. So please tune into one of those topics as part of today's event to make sure you do consider what happens to the estate and potentially leaving that legacy to the next generation as part of your retirement and also your personal estate. Now, Australian Super do aim to provide members with the help, advice, and guidance they need when they need it. We have our calculators. We have a simple advice service available over our phone number. We also have a comprehensive advice service where we have advisors around Australia to help members with this potentially more complex financial advice, such as Mark Vincent, who's joined us today. So thank you very much for sharing your expertise with us, Mark.
Thank you for
It
having me,
is a
Andrew.
pleasure to have you along. And this does bring us to the end of the self-funded retirement session, What to Consider. And you can now return to the lobby for the next presentation. So thank you for joining us.
Thanks, everyone.